Hello everyone, welcome back to my channel. So this is the video that I've been promising to do for quite a long time, and unfortunately I could not do it sooner because of work commitments. Last few weeks I've been busy, but now finally I found the time to do one of these. And so in this video we are going to delve into the options strategies, which are a little bit more complex. In case you are already comfortable with the basic strategies, this one will be typical. These ones, the advanced ones, will be typically used to help you get into trades which are a little bit more customizable and that suit your trading style a little bit better and allow you to take advantage of other opportunities that the market will present to you as the time goes on. And so let's dive into it. So basically the reason why we can use advanced strategies, it's precisely of these three reasons here on the screen. First of all, it allows you to manage your exposure to risk in your trades, because each and every investor has its own risk tolerance. It has a specific amount of capital to use, and so based on all these variables, a trader can use strategies which are tailor-made to its own capacity and also its willingness to take on risk. Again, similar to more basic strategies, such as basically the wheel strategy, for example, which I'm currently using most often. These are also used to generate income, especially when it comes to the strategies which involve short positions, because you get to receive the premium. And so you basically expect that the short positions expire worthless, and so you get to pocket the premium when these options reach their maturity. And also, as I mentioned, related to risk management, these strategies are also quite flexible, because you can modulate your exposure and how much can you expect how much and how often can you expect from profit from these strategies, according to your risk tolerance, and how much of a percentage of trades do you want to win or profit from. Even more so, of course, given the fact that there must be a trade-off between the percentage of trades in which you come out winning and of course the amount of profit that you get from each of them, because of course the higher the likelihood that you require to get a profit, of course the lower will be the actual profit on each trade. But we'll get to see later, as we move on, how these strategies basically are based and what they basically entail. And so let's start first and foremost with the vertical spreads. Now, the vertical spreads, just to explain, are basically they basically include a position on two options. And so you basically use a short position and a long position in an option with the same maturity. So both options have the same maturity, but the strike prices are different, and so that is why they are called vertical spreads. I will talk about in another video, because I decided not to include all of them in this video, otherwise it will take too much time. But there are, for example, the horizontal spreads, which are basically two options with the same strike price but with different maturity rates, and there are also diagonal spreads, which involve two options with different strikes and also different maturity dates. But we'll get to those at a later stage. For the time being, And to talk about the vertical spreads, there are several setups that we can use depending on our expectation. If we expect the stock price to go up, we can use a call debit spread, and this is also called by some traders as a bull call spread. And why is that? Why is bull call? Because it is based on the expectation that the stock price will go up, and hence the bull. It's a bullish trade. And also another one, but with puts, if you expect the stock price to go up but you prefer to use put, you use the bull put spread or the put credit spread. And also in the same way, if you expect the stock to go down, you can use the bear put spread if you want to use puts, or you can use the bear call spread if you want to use calls. And so I can show you, if we use a trade, or if you open up your trading platform, in my case I use Interactive Brokers, I can show you, for example, and let's just open here an option chain, for example, on American Airlines, and I will be able to show you each of these. And so starting, for example, with the bull call spread, as you can see right here, with the bull call spread, basically you buy a call option. All right, let's just say, for example, you buy this one here, and as you can see right here, this is the profile of a long position on a call, and then you sell a call with a higher strike price, for example this one. And so you will see that if the stock price goes up, you will profit. All right, but of course there is a maximum, there is a limit on this profit, because if the stock goes beyond the 15 in this example, you will not profit anything from it. And so basically you will be required to you will be required to sell the option at 15, and any value beyond that you won't be able to capture. And so if at the end of this trade, if the options, both options expire, if the stock price expires above 15, you can buy if I just say, for example, that expires at 16, you have the option to buy it at 14 and then sell it at 15. So you'll profit $1 per each stock. Now each contract has 100 stocks, so you'll be able to profit 100. And if both options expire worthless, because, for example, the price at maturity ends up at 12, for example, you will not exercise this option, because it makes no sense to buy it at 14, because it's when its actual price is 12, and this option also expire worthless, and so basically you will lose the premium. All right, and so which is basically 60 cents per stock, so times 100, it will be $16. Now this can be a little bit different, because, for example, you may want to get more profit out of it if the trade goes in your favor. And so, for example, you want to buy the stock cheaper, all right, at the cheaper strike price. You can do that. For example, you can go, for example, for the 12, but of course, as you can see here, it will cost you much more, because it will cost you 160 to buy this option, and then you will have to sell a call with a higher strike price, and so you'll have to pay more in order to get a higher return. In this case, you'll get $3 per each stock if the trade goes in your favor. All right. In the same way, if the stock goes down in price and both options expire worthless, your loss also is much greater. And so you can do this with calls. All right. You can also do the same with puts. All right. And so basically, in a bull put spread, you will do the same, but you will be able to do this with a put. All right. And so, for example, if it's the other way around, so you can do this, for example, here, and do it like this. And so you will see that, for example, if we let's just use the same example as before. this one right here, yeah, for example this one. So you see that you can profit $1 per each option, because per each stock, because in here you will be able to sell to sell the option, and you'll be able to sell the option at 14, all right, and so you bought it at 15 if this trade goes against you. You mean if the stock, if the trade goes against you, it will go right here. The stock goes down in price, you'll have a loss of $1 per stock, because this put will be exercised and this put will also be exercised. So you will buy the stock at 15 and sell it at 14, right? But if the stock goes in your favor and expires, for example, at 17, you will be able to pocket the premiums, because both of these expire worthless. This expire worthless, this expire worthless. You get the net premium. This premium is higher than this one, and so you'll gain this much money, which is the difference between the premiums. Now, for the bear call spread, it's the other way around. Basically, you will buy a call option with a higher strike price than the one that you sell, and so as you can see right here, it goes in a different way. If the stock goes down, you buy at 14, all right. I mean, if the stock goes down, both expire worthless. You keep the premium, all right. This sometimes gets a bit confusing because there are 4 spreads, and so if the stock goes down, both expire worthless. You keep the difference between the premiums, because you receive 69 and you pay 18. But if the stock goes against you and increases in price, what happens is that you will, because both will be exercised, basically you will buy at 14 and sell at 13, so you'll have a loss of $1 per share, all right. And so if the trade goes against you. Now, if you want to do a bear put spread meaning with put options, it will go the other way around, because you will have to basically use the same reasoning with the puts. And so, for example, if you sell a put with this one, all right, if you buy a put at this price, and then you will sell, for example, this put right here, if the stock goes down, both puts are exercised, all right, and so basically you will sell a stock at 14 and sell it at 13, so you gain $1 per each option. But if the trade goes against you, both options expire worthless, and so you basically received 12 cents, and you bought and you paid 62 cents per each of these options, so they simply expire worthless, all right, and you lost the difference. And so this is how the vertical spreads work, all right. And so this is the way to go if you want to use this trade. Of course, risk and return, as you can see, it is limited, because as you can see in the graph, the risk and return are both capped. You can have a larger spread at a higher cost, but of course the potential for return is also higher. And so this is customizable, because if you want to have a higher potential for a higher profit, you have to pay more, or you receive less in premiums. So basically, it's a decision that you make at the time you set up the trade. Now, moving on to the next one, which is basically a combination of vertical spreads, because as you can see here in the vertical spreads, you can use calls or you can use puts, all right. And so basically, the next one, which is called the Iron Condor, it's a strategy in which you put a spread on the side of the puts, and which of course both puts are out of the money, and you use another vertical spread on the side of the calls and also out of the money. So as you can see, it's a combination, for example, of the put credit spread and the call credit spread. All right. If you want to use a short iron Condor, it's a put debit spread and a call debit spread. It's the inverse. And so I will be able to show you here how the iron Condor works. So, for example, American Airlines stock is trading at 13.58 by the time markets closed on the previous trading day. And so we have basically to do the following. For example, we sell this option, all right, and then we buy this option right here. And so you will see this profile, all right, and now you see this is basically a put credit spread. And now we're going to do the same for the calls. Basically, we are going to sell a put, for example, this one, a call. We're going to sell a call, for example, this one, and we will buy another call, this one, as you can see right here. So basically, you'll have this profile. And by having this profile, what does this mean? This means that basically you win when the stock remains within this small range. Now, as you can see, even the line is red, because meaning red, that means that these outcomes here across the red part of the line, that means that these will cause you to lose. But in this portion here of the green, if the stock remains within this small range right here, you win the trade. All right. And so as we know, the stock can, for example, end up here, both options, all the options expire worthless because they remain within this typed range. If the stock remains, for example, within 13.5 or above, if the stock ends up between 13 and 15, all these options expire worthless. All right. And so by doing so, it will happen that you pocket the difference. But in order for this to happen, you have to make sure that the stock price will finish within this range, because otherwise you may lose money. And so this is the way to do it, right? If, for example, if you go ahead, you will see that the platform calls him an iron Condor right here, as you see. And so the main outcome is for the stock, the best outcome possible is for the stock to remain with this range. Now, if the stock goes out of this range, at least the good thing about the iron Condor is that if the stock goes up or down by a lot, your losses, because of course you will have a loss, your losses will be limited. Because, for example, if the stock goes to 10, all right, at least, of course, you will have to buy you will have to buy it at 13, but you have the option to sell it at 12. And so instead of having the entire loss up to 10, you can sell the option at the stock at 12, and so your loss is limited to $1 per share. In the same way, if the stock skyrockets, you'll have to sell it at 15, but at least you can buy it again at 16, and you profit the rest of the way, all the way until wherever the stock finished, for example, at 18. All right. And so if the stock, for example, finishes on 18, you will lose $3 here by selling the stock at 15, but at least you buy it at 16, so your loss is only $1 instead of the 3. And so this is the way to do it. Now, this of course is for neutral or low volatility stocks, which is what happens most of the time. All right, when you trade, the market is usually under low volatility. So this is usually one of those trades which give a very, very little profit, a relatively little profit, but it profits for most of the time. And of course, again, just like the vertical spreads, the risk and return are limited and customizable, because you can aspire to have more premium, and by doing so, if for example you simply put the buy the puts and buy the calls further away from the money, all right, and so because the options that you buy are so much cheaper than the options that you sell, you pocket a bigger premium. But on the flip side, if the trade goes against you, as you can see right here, the losses are much bigger. All right, and so there is always a trade-off between the potential profit that you get if the trade goes in your favor versus the potential loss if the trade goes against you. All right, in the end, it's a matter of risk tolerance. All right, and so just to show you very quickly, you can use the same thing but for the short iron condor, which is basically the reverse trade. And we can use, for example, here we can buy this put, sell this put, and again, if we buy this put and sell this one, you will see that you will have the short iron condor, and this time you profit when the stock skyrockets, because if the stock skyrockets, you buy it at 14 and sell at 15. Of course, the gains are limited, but that's the way it is. And if the stock plunges down, you sell at 13 and you buy it at 12. So that's how you profit with a short iron condor, and you can see it right here, short iron condor here. All right. So this was the iron condor, and now we move on to the next one, which is one that attempts also to profit, but from very high volatility, and these are the straddles. It's a simple strategy. You simply buy a put which is at the money, and you also buy a at the money call. All right. Basically, they have the same strike price, and so by cleaning this up, for example, since the stock is trading at 13.58, the closest option to the ATM is a 13.50. So basically, we are going to buy a put and we are going to buy a call. And so this is the profit profile of a straddle. You can see here, this is a straddle. All right. If we do the inverse, we will have a short straddle. All right. And you can see it right here, and you can see also the name, short straddle. But let's focus for the time being on the long version. All right, so this is the long version. All right, and so as you can see here, because these options are at the money, or as close as possible as at the money, this is quite costly. It costs more to set up this position, this strategy. But of course, as you can see right here, if the stock skyrockets or if the stock plunges, you will be far into the money. And so this option, this strategy has a lot of profit potential, potentially unlimited, because there is no upper limit to where the stock can go. On the lower side, the stock can at the limit go to 0, and you still get to sell it at a strike price, in this case 13.50. And so most of the outcomes end up in profit, but the probability that they will end up in here in the green part of the profile are much lower on average than staying as it is here near the strike price. And so as you can see, this is a strategy that it's used when there is expected volatility to be high, right? When you expect either a strong rally or a crash on the stock. This is especially when there are volatility events coming, such for example an earnings release, when either stocks usually go up very strongly or go down very strongly as well, and so the return is potentially very high. You can also another feature of this strategy is that you cannot customize, because you have to buy and sell the ATM, the at the money put and call. So there is no way to set up this trade. You have to buy the ATM, all right? And so this is the way to do it. With the short strangle is the inverse. You want to profit. The strategy gives you a great amount of premium, all right? But on the same way, as you can see, it has a relatively there are a lot of outcomes that will make you lose money. A slightly bigger move and you are already losing, and of course your gain is limited to the premium that you already received, and so this is how it is. And so, but again, it's not customizable, because again the short positions have to be done with the ATM calls and puts. And so, and the other strategy that I wanted to show you is also similar to the straddles, which are the strangles. You can use a long strangle or a short strangle. Here we are talking about the long version of the strangle, in which you buy out of the money put and out of the money call. And so in this situation, basically you can buy this one, and you can buy for example this one right here. And as you can see, the profile is similar, but there is a larger probability that the stock what I mean is that there is a larger range of outcomes in which the trade will lose money. This red area right here is a little bit larger than on the straddle, but because these puts and calls are out of the money, it costs you less to set up this trade. And so again, the trade-off between how much you pay in premium and the expected profit potential that you may get. All right, and so you see that also this strategy gives you a slightly lower potential of profit than the straddle, but also costs you less to set up, and hence the trade-off. As you can see here, also it recognizes that this is a strangle here, and you can also use the short version of the strangle, which is right here. For example, this one, my mistake, this is the one. It is the same, and again, this profits from low volatility. All right, and you can see that this is also recognized as a short strangle, and it profits when the stock remains between 13 and 15, because both options expire worthless, and so you pocket the premium. Anywhere below 13 or above 15 in this example, and you may start to accrue losses if they are very close to 15 or 13, but if you go much further than that, for sure you will end up losing the trade. And so this is also, in the case of the long strangle, it's used when you have high expected volatility, again strong rally or crash, returns potentially very high at a lower cost than the straddles once again, and it's customizable because of course the options are out of the money. You can have a very tight strangle. For example, if you use this 13 and a half, and this 14 right here, all right, you pay much more, but the set of outcomes that allow you to profit are also bigger. Or you can, if you don't have that much money, or you don't want to spend that much money, you can have a much larger strangle here. This strangle also almost costs you nothing, but it has a very large set of results in which you will end up losing the trade, and so a much larger swing of the price is necessary for you to profit. Again, the trade-off is in play. And this also is the same for for the short. The reasoning is the opposite for the short, the short strangle. And so basically this is what I wanted to show you in terms of the trades. There are other complex strategies, but those have to stay for another video, because yeah, I don't want to make this video too long. And so basically this is a breakdown of all that we have been we're talking about: vertical spreads and an iron condor. And of course we are talking about the normal versions of the trades. Vertical spreads, iron condor is the iron condor, not the short iron condor. And here the straddles and the strangles are the long versions, all right, of those strategies. The cost, you may have a net outflow or a net inflow for the vertical spreads, depend is a credit spread or a debit spread, all right. And the iron condor is always a net inflow, because the options that you sell are closer to the money than the options that you buy, so the premium of the options that you sell are higher always, all right. Here the straddle, the long straddle, the outflow is the largest, right, because the options are at the money. Here the outflow is also significant, but less than the straddle, because the options are out of the money, and so they cost less, all right. In terms of the use, the vertical spreads can be used whether the stock will go up or will go down, right, depending on your expectation. But again, it profits the most when there is low volatility, all right. The iron condor is also similar, profits with low volatility and bets that the stock will stay within a small range, which is a range that allows you to maximize your profit, right. And for the strangles and the straddles, you gain, or you should use it when you predict that the stock will either rally or crash, right. In terms of the risk, this is, of course, in terms of vertical spreads, they are limited and customizable, same with the iron condor. It depends on the difference between the strike prices that you set up. In the case of the straddles and the strangles, this is also customizable in the case of the strangle, all right. But in the case of the straddle, it is not customizable, all right, because you simply have to buy the puts, the calls, which are in the at the money, all right, the calls and the puts which are not in the money. So that is why you cannot customize this trade. It is what it is, right. And in here, in terms of the return, again, you can get as much or as less as you want in terms of potential profit, all right, not certainty, but in terms of potential. In here is also customizable in the case of the strangle, and but it's not customizable in terms of the straddles. You pay the most. There is only one way to set up. You have the risk, which is you pay the highest amount of premiums, but of course it takes a lower swing for you to be in the profit. It depends on your risk tolerance, but this is basically it. And again, another important topic, which is the time decay, how much the strategy benefits from the passage of time. Again, credit spreads, because the put in the credit spread, the option that you sell is more valuable than the stock that the option that you bought. So you get a net premium. You receive a net premium, and so if the trade expires worthless, the options expire worthless, you benefit from the time decay. In the case of debit spreads, because you paid more than in premium than what you received, time decay goes against you, and because of that you need the stock to go in your favor in order for you to profit. In here it doesn't need to. In the credit spread, it doesn't need to. You simply profit by the stock either going in your favor or stay where it is, and so you simply pocket the premiums, and that's it. In the debit spreads, you need the trade to go in your favor. Iron Condor is the same reasoning, because you receive a net inflow, a net premium. If nothing happens, if the stock stays where it is and all the options expire worthless, you pocket the net premium, so you benefit from time decay. In the case of long Strangles and long Straddles, because you paid a net premium, what happens is that time decay goes against you, and so you will need the stock to go in your favor, the stock price to go in your favor in order for you to profit. And so basically this is it. This is what I wanted to show you. Again, as you can see, most advanced strategies allow you to tailor-made the strategy, set up the strategy in a way that suits your risk tolerance and your appetite for risk, basically, and how much return you intend to be in a position to try to get. But again, this requires always to continuously assess your risk tolerance, because if something happens that reduces your risk tolerance, you might want to adjust your trades to make sure you don't suffer a loss that may cripple your budget and your portfolio. But for the time being, this is it. I will make another video on other strategies when I have some more time, because there are a few other complex strategies that are worth to talk about. For the time being, this is it. Feel free to leave your comments below, like the video and subscribe to the channel. Also, if you believe that this sparked your curiosity and want to know a little bit more about it, also feel free to drop me a message on LinkedIn. I would be more than happy to further this explanation over a DM in there. And so yeah, this is all. I'll see you all in the next one.